Hello YouTube universe, welcoming you to another video of Do Not Buy a House. Instead, do this 10 ways to make real money. Do subscribe and stay tuned for a few minutes. Number 10. Flip retail products. Take advantage of online sales platforms such as eBay or Amazon and sell products that you find at cut-rate prices elsewhere. You'll arbitrage the difference in your purchase and sale prices and may be able to build a following of individuals who track your deals. You'll be able to take advantage of price differences between what you can find and what the average consumer may be able to find. This could work especially well if you have a contact who can help you access discounted merchandise that few other people can find. Or you may be able to find valuable merchandise that others have simply overlooked. While sales can happen anytime online, helping make this strategy passive, you'll definitely have to hustle to find a reliable source of products. Plus, you'll have to invest money in all of your products until they do sell, so you need a robust source of cash. You'll have to really know the market so that you're not buying at a price that's too high. Otherwise, you may end up with products that no one wants or whose price you have to drastically cut in order to sell. Number 9. Buy crowdfunded real estate. If you're interested in investing in real estate but don't want to do a lot of the heavy lifting, management, repairs, handling tenants, and more, then another option is using a crowdfunding platform to invest in property. An experienced investing team picks out the real estate, and then you can decide to invest in it and how much you're comfortable with. You'll pay an annual management fee to the real estate platform and have minimum investment amounts that could range from $10 to tens of thousands of dollars. You can get access to private real estate deals that may be attractive, and they've been pre-selected by knowledgeable investors. You can check out the returns on the platforms, so you'll have some idea of what level of returns you can expect and over what time frame. Real estate investments can also help diversify your portfolio, helping to smooth your returns. Some platforms invest in equity, stock, while others invest in debt. Generally, stock offers high returns in exchange for more risk, while debt offers lower returns in exchange for less risk. Some platforms require you to be an accredited investor with a certain minimum income or assets. Popular platforms include Fundrise, YieldStreet, and DiversiFund. Number 8. Peer-to-peer lending. A peer-to-peer, P2P, loan is a personal loan made between you and a borrower, facilitated through a third-party intermediary such as Prosper. Other players include Payoff, which targets better credit risks. As a lender, you earn income via interest payments made on the loans. But because the loan is unsecured, you could end up with nothing in the event of a default. To cut the risk, you need to do two things. Diversify your lending portfolio by investing smaller amounts over multiple loans. At Prosper.com, the minimum investment per loan is $25. Analyze historical data on the prospective borrowers to make informed picks. It takes time to master the metrics of P2P lending, so it's not entirely passive, and you'll want to carefully vet your prospective borrowers. Since you're investing in multiple loans, you must pay close attention to payments received. Whatever you make in interest should be reinvested if you want to build income. Number 7. Dividend stocks. Shareholders in companies with dividend-yielding stocks receive a payment at regular intervals from the company. Companies pay cash dividends on a quarterly basis out of their profits, and all you need to do is own the stock. Dividends are paid per share of stock, so the more shares you own, the higher your payout. Since the income from the stocks isn't related to any activity other than the initial financial investment, owning dividend-yielding stocks can be one of the most passive forms of making money. The money will simply be deposited in your brokerage account. The tricky part is choosing the right stocks. For example, companies issuing a very high dividend may not be able to sustain it. Graves warns that too many novices jump into the market without thoroughly investigating the company issuing the stock. You got to investigate each company's website and be comfortable with their financial statements, Graves says. You should spend 2 to 3 weeks investigating each company. Compare your investing options with Bankrot's brokerage reviews. Number 6. Create an app. Creating an app could be a way to make that upfront investment of time and then reap the reward over the long haul. Your app might be a game or one that helps mobile users perform some hard-to-do function. Once your app is public, users download it, and you can generate income. An app has huge upside if you can design something that catches the fancy of your audience. You'll have to consider how best to generate sales from your app. For example, you might run in-app ads or otherwise have users pay a nominal fee for downloading the app. If your app gains popularity or you receive feedback, you'll likely need to add incremental features to keep the app relevant and popular. The biggest risk here is probably that you use your time unprofitably. If you commit little or no money to the project, or money that you would have spent anyway, for example, on hardware, you'll have little financial downside here. However, it's a crowded market and truly successful apps must offer a compelling value or experience to users. Number 5. Rent out a parking space. Do you have a parking space that you're not using or that could be used by someone else? You could trade that spot for some cash. It could be an even better setup if you have a larger area that could fit several cars or that would be useful for multiple events or venues. In particularly high-demand areas or during high-demand times, for example, during a concert or sporting event, your parking spot could be worth real money. For example, if you live near a place that has frequent commuters but that is strapped for parking spots, you might have a moneymaker on your hands. You might have the best chance of turning a profit by renting to someone who needs the spot on a daily basis, rather than for one-off events. This idea might not be particularly risky, but you do want to make sure you aren't violating any restrictions from your place of residence or other entity by renting out a parking space. It's probably worthwhile having a disclaimer of liability as a condition of parking in your spot too. Number 4. REITs. REIT is a real estate investment trust, which is a fancy name for a company that owns and manages real estate. REITs have a special legal structure so that they pay little or no corporate income tax if they pass along most of their income to shareholders. You can purchase REITs on the stock market just like any other company or dividend stock. You'll earn whatever the REIT pays out as a dividend, and the best REITs have a record of increasing their dividend on an annual basis, so you could have a growing stream of dividends over time. Like dividend stocks, individual REITs can be riskier than owning an ETF consisting of dozens of REIT stocks. A fund provides immediate diversification and is usually a lot safer than buying individual stocks, and you'll still get a nice payout. Just like dividend stocks, you'll have to be able to pick the good REITs, and that means you'll need to analyze each of the businesses that you might buy, a time-consuming process. And while it's a passive activity, you can lose a lot of money if you don't know what you're doing. Like any stock, the price can fluctuate a lot in the short term. Number 3. A bond ladder. A bond ladder is a series of bonds that mature at different times over a period of years. The staggered maturities allow you to decrease reinvestment risk, which is the risk of reinvesting your money when bonds offer too low interest payments. A bond ladder is a classic passive investment that has appealed to retirees and near retirees for decades. You can sit back and collect your interest payments, and when the bond matures, you extend the ladder, rolling that principal into a new set of bonds. For example, you might start with bonds of 1 year, 3 years, 5 years, and 7 years. In a year, when the first bond matures, you have bonds remaining of 2 years, 4 years, and 6 years. You can use the proceeds from the recently matured bond to buy another 1 year or roll out to a longer duration, for example, an 8-year bond. A bond ladder eliminates one of the major risks of buying bonds, the risk that when your bond matures, you have to buy a new bond when interest rates might not be favorable. Number 2. Sponsored posts on social media. Do you have a strong following on social media such as Instagram or TikTok? Get growing consumer brands to pay you to post about their product or otherwise feature it in your feed. You'll need to keep filling your profile with content that draws in your audience, though. And that means continuing to create posts that grow your reach and engage your followers on social media. Leveraging your social media presence is an attractive business model. Draw eyeballs and clicks to your profile with strong content, and then monetize that content by setting up sponsored posts from brands that appeal to your followers. Even when you've got the sponsored posts you're looking for, you'll need to keep posting to draw in your audience and remain an attractive option for advertisers. That means committing to more time and monetary investment, even if you do have a lot of autonomy on exactly when to do it. Number 1. Invest in a high-yield CD or savings account. Investing in a high-yield certificate of deposit, CD, or savings account at an online bank can allow you to generate a passive income and also get one of the highest interest rates in the country. You won't even have to leave your house to make money. To make the most of your CD, you'll want to do a quick search of the nation's top CD rates or the top savings accounts. It's usually much more advantageous to go with an online bank rather than your local bank because you'll be able to select the top rate available in the country. And you'll still enjoy a guaranteed return of principal up to $250,000 if your financial institution is backed by the FDIC. As long as your bank is backed by the FDIC and within limits, your principal is safe. So investing in a CD or savings account is about as safe a return as you can find. And that return can pale in comparison to inflation, hurting the real purchasing power of your money. Nevertheless, a CD or savings account will yield better than holding your money in cash or in a non-interest-bearing checking account where you'll receive nothing. If you find yourself smiling, learning, or just having a good time during this video, do me a favor and subscribe. Let's spread those positive vibes together.